Are you ready to take your trading to the next level?
In today's video, I'm going to be diving into the top ICT strategies that can help you spot high probability trades and improve your market understanding. Whether you're a beginner or an intermediate trader looking to refine your approach, these strategies will set you up for success on your trading journey. Before proceeding, please don't forget to subscribe, hit the like button, and also don't forget to turn on notifications so you can get other updates or new uploads I upload on this channel. Do note that the videos you are about to watch are pre-recorded sessions or pre-recorded courses of the top ICT models or concepts that will help you increase your trading expertise. First, let's look at the OTE, which is the optimal trade entry. The optimal trade entry, or the OTE, helps you identify entry point or reversal point where price is likely to retrace to, then respect. An OTE, or an optimal entry point, is if, for example, the market is doing something like this. Let's correct this. Let's give an example that the market is doing something like this. Buying, sell, break structure. The OTE helps you to identify where exactly in these areas will price retrace to. In the selling example too, you'll know it there, and it's only around the 618 or 716 level of the Fibonacci. So we are expecting price to come back to the OTE, then buy from that level. That is what we're expecting price to do. And if you look, the second time too, price also respected the OTE, or the 618 level. If I should add the 618 level, you will see it clearly right here. If I should add the 618 level, you can see it. If I should add the 618 level, you will see it right here. It only respects the 618 to 786 level. Same thing right here. You only mark from the high to the lows or from the lows to the highs. That's how the optimal trade entry, or the OTE, works. Let's talk about the FVG, or as you know it, the fair value gap. The fair value gap is a very great concept that deals with the jump or dump in price when price move with a certain way. It means the fair value gap only tells us, it's a language that tells us that yes, there is momentum and there is liquidity inside this particular space, and it forms within 3 consecutive candles, bullish or bearish, but I'm going to be using the bullish example. Now, for the bullish example, in the 3 consecutive candle, the top of the last one to the bottom of the first one is the fair value gap, and we expect price to come back into that fair value gap and respect it. The space or the gap left in this particular place is caused by a huge pump in price or a huge liquidity in price. If it has wicks, this is the exact same chart, but just in case it has wicks, if the candles has wicks, you draw the fair value gap from the wicks, which we expect to go from into this place to that place. This is the fair value gap. This is the concept of how it works. At the end of the chart, I'm going to be showing you examples for the OTE, the fair value gap, the Q zones, and the liquidity. Let's dive into the concept of Q zones. Q zones are simply particular times in the market when price either dumps or pumps. For example, these are Q zones. If you notice, from the first of every month, there is always a downward move in price. In the first of every month, there's always what? A downward move in price. This can serve as a pretty good example for us that at the first of every month is when one or any trader should be looking to short the market. As you can see, that shows that yes, this particular kill zones is effective. It shows that the particular kill zone is effective. Now, if you want to use kill zones, for example, it only shows that, okay, for example, every 1 hour, what do you find? From 1 o'clock every time, from 1 every day, from 1 o'clock to 12 is when one should be looking for opportunities. That's the example of kill zones. From 1 o'clock to 12. Let's talk about liquidity. As we all know, liquidity is a very key importance in price. But whether you're a beginner or looking to increase your win rate or get more exposure in the financial market, you need liquidity. You need to understand the concept of liquidity. Liquidity is basically money. Levels where money flows widely. There are levels where money flow widely, where market is expected to go to, respect, or go to. Those are liquidity levels. Liquidity levels are where market is expected to go to. Or there are different concepts of liquidities. You can find liquidity sweep, liquidity run. For example, if you get higher high and higher low and higher high at an uptrend, this lows is liquidity. So do not expect price to come below that low. If price comes and sweep that low, gives a fake out, then continue going up, it becomes a liquidity sweep. But if price changes in trend entirely, it becomes a liquidity run. Now let's see this chart. You can see there is a liquidity sweep. You see this low here, well, this market respected. There is a liquidity sweep right here, and just like I said, now the market has switched to the uptrend. What do we find? This low, market respected it, but there is always a liquidity sweep. A liquidity sweep is like a fake out that tells us that yes, the market is going up. Now this swing low, market also respected this new swing low right here, but there is a liquidity sweep before market continued going up. I don't know if you understand the concept of liquidity sweep. So we are going to be looking at the examples. The next page you'll be seeing is the examples of all the concepts I've explained so far. So I'm going to be going over some examples, and I might also show you guys an example of all the concepts together. It is possible to work all the contents into one together. It is possible. But then, how do you work all the concepts into just one determining price action? Now here's what we're going to do. We're first going to explain OTE. As I explained earlier, OTE is the optimal trade entry. Now how it works is, if you see an high and a low, for example in an uptrend, you draw your OTE from the low to that high, expecting price to bounce off of there. As you can see, some live examples. Now let's imagine this hasn't played out, because I don't know why Deriv doesn't have the Deriv doesn't have bar replay. So as you can see, from this top to this high, our OTE can be where we will place our entry, our pending order, stop loss below the OTE, take profit at that high, and you can see price end up respecting that particular OTE. Let's also do some back tests and some examples of how valid this particular price action can be. You can see from this low to this high. Let's stretch it outward, and you can see that the exact way I explained it is the exact way it works. Now this is a 1 to 3 hour. This is 2 trades. Let's keep back testing it and see. This is also another example for a broker with a wide spread. This will actually take you out, but as you can see, it's actually a TP aiming for at least 1 to 3 hour. And even when we look lower, you can see, if we look at the opposite trend, you know, it's not all winners, not all trades you will win, but still this has a pretty high win rate. This will help you identify market structure earlier or better than you've ever been identifying market structure. Yeah, if you keep going, we would find that the market, this particular concept, has a very high win rate with a minimum risk to reward of at least 1 to 3. As you can see, it's there, it's obvious. It's a minimum risk to reward of at least 1 to 3. You can see, if we look for this uptrend here, if we look towards this uptrend here, we didn't have any retracement through there. Also, from this one right here, we didn't get any retracements, meaning that obviously you are meant to stay away from that market at that particular time. And then when we finally got an entry, we still didn't get an entry here though, but when we finally got an entry right here, it was a loss, but still if a win rate as high as that, 1 loss, 2 loss, 2 loss, 4 wins with a minimum of 1 to 3 hour, yeah, that's about like 6% in just like a particular time. Now let's look at FVGs. I explained earlier in the video the concept of fair value gaps. As you can see, if you backtest this market respected this fair value gap right here. So if we were looking to buy, we would have bought from this exact fair value gap, stop loss below the fair value gap, and then take profits, you know, let's say minimum of 1 to 2, and we are good. The market will always obey every single concept. You just have to pick one and stick to it. As you can see, also respected this tiny fair value gap right here, respected it, and yeah, exact same thing. It will always respect it. The market will always respect the fair value gap, though not every time you win a trade. As you can see, this would have definitely stopped you out, but if you had entered here and put your stop loss at this low, following the rules of price action, it's supposed to be at this low, and it targeted the highs for a 1 to 2, this would have been a win for you too. But on this would have definitely been a loss, because you won't know where to put your take profit or your stop loss, in fact. And that is where the optimal trade entry comes in place. I can show you how to mix every single concept together. Let's also look at the concept of liquidity. What do you find here? Liquidity sweep before the market shut up. Also same thing here. Let's mix the concept together, but it is advised that you pick one and focus on it. We're looking for a trade at this particular level. We try our optimal trade entry, and we saw it got to that level. Now in that level, there is also a tiny fair value gap right there, and then there is a liquidity sweep, and you can see this is exactly midnight, a Q zone. So you can enter stop loss below there, and take profit basically at that, as those eyes right there. And there you go, the 1 2 3, using all the concepts I taught in the video. Same thing with this particular place. It happens everywhere, but you just need to master one concept and stick to it. For example, the fair value gap concept is what I use personally, and trust me, it works. If you focus on it, you don't look at the losses, it works in the long run. This is also an example of market respecting the fair value gaps. As you can see, you don't respect it here. Not every time you get not every time you get the correction you need from the market. But as you can see, what does market always do? Look at this fair value gap right here, respect it. Same thing right here, respect it. You choose one concept. Okay, let's look at the concept of liquidity sweep. Let's say we are planning to buy from here. Let's say we are planning to buy from this particular level. Liquidity sweep, respected. What other liquidity sweep do you find? Liquidity sweep, respected. Liquidity sweep, respected. Always on that particular level. Liquidity sweep, respected. You should always look for that one. As you can see, this liquidity sweep here wasn't respected because as it is said, not every time you get a win, but in the long run you can be consistent. Liquidity sweep, respected. Same thing with the Q zones. I hope this video was educational, and I do hope you learned 1 or 2 things from this particular video. Pick a concept. You can pick the OTE, the FAG, the Q zones, or the liquidity, or if you have a model you trade, you can add 1 or 2 of those concepts to your model to get to make you see markets clearer, in a clearer way where you don't have to look confused. Thank you so much for watching this video. Please like, subscribe, turn on the notification bell so you get updates on any other educational or day in the life contents we drop.